But that's going on in the world. So let's chat about what's really happening with regards to the Delta variant, how the FII price action has been, what's happening across the commodity universe. We've got none other than Jim Rogers, author at Street Smarts, Adventures on the Road and in the Markets, joining in on the show right now. Jim, hi, good morning. Good to have you on the show. Jim, the big talking point this morning is that already some of the U.S. companies are getting a little bit cautious, and U.S., it seems, is preparing for the Delta variant. You've got Amazon, which is already pushed back their work from home timeline. What about the markets, though? I mean, if I look at India, if I look at most other developed markets as well, they seem to be completely shrugging off any threat from the third wave or the Delta variant.
Well, as you know, markets everywhere have been going through the roof. I mean, this has been unprecedented because we've had so much money printing by central banks all over the world. I'm not good at market timing, but I'm sure it's going to be coming to an end sometime in the next few months. This has never happened before.
Yeah, unprecedented as it may be. You know, just looking at, Jim, what's happening across the commodity universe, and, you know, much unlike equities, I would say commodities are getting a little bit more sensitive to the news flow around COVID. We've seen a bit of a knee-jerk reaction come in on crude, for instance, overnight. What's your own sense on how crude is likely to shape up? Because, you know, that, of course, has a lot of domino effect, if I can call it that, on raw material prices, on inflation, and thereby, you know, earnings of corporates.
Well, the cheapest asset class in the world at the moment happens to be commodities. Bonds are in a bubble everywhere. Many stocks are starting to form a bubble. Property, as you know, in Korea, New Zealand, many places is in a bubble. But commodities are still cheap. I mean, you know, silver's down 50% from its all-time high. Many commodity, oil is down over 50%. I don't know whether oil is going to go up or down this week. It's not terribly relevant to me, but oil is known reserves of oil continue to decline. The fracking bubble has popped, and so I would suspect you're going to see strength in oil in the next few months. Not every day, not every week, but oil is down a lot from its all-time high.
Hi, Jim. This is Mubina as well joining in. You know, you speak about when you say that the known reserves of oil continue to fall, the fracking bubble has popped. You're speaking from the supply point of view. But what about prospective demand? It's very clear that, you know, the world wants to move EV, the world wants to move away from fossil fuel. We will not look at weekly moves and monthly moves. We look at long-term moves. Don't you think that fundamentally then the picture for oil does not look all that strong, especially as countries seem to be pulling forward their targets for lower carbon emissions?
It does seem clear to the world that we're going to have electric vehicles in the future, but Movina, this takes a long time. If you remember Henry Ford's wife had an electric vehicle. She did not like internal combustion engines. She insisted that electric vehicles were the future. Well, she was over 100 years too soon. Yes, they're coming, but it's not going to happen overnight. And in the meantime, reserves of oil continue to go down. I'm not urging you to rush out and become an oil trader by any stretch, but I would not give up on I am not giving up on the price of oil yet.
So where do you see the price of oil in the long term? And, you know, at what point would you realize that, okay, this is end game for, you know, crude?
Watch ET, they can tell you. No, there are many alternate sources of energy coming, solar, especially solar, wind, ocean power, many kinds of alternatives are coming, but it's going to take a long time. So, and as I said, oil is down 50% from its all-time high, and known reserves everywhere in the world, including Saudi Arabia, continue to decline. The fracking bubble has popped. You know, fracking's still here, for a while there, if you could spell fracking, they gave you money so you could go into the fracking business. Well, that's not happening anymore. And in the meantime, reserves go down. It would not surprise me at all to see oil much higher over the next 2 or 3 years because of supply and demand. Remember, there are two sides to this equation. And electric vehicles are coming. I can see that. I can watch ET as well as you can. But it takes a while, as Henry Ford's wife found out.
Well, that's some trivia you've given us, Jim, and I guess it's for people like you that one needs to continue to stick with ET now, because we get a lot of knowledge that at least we were unaware of. But the other, commodity angle, Jim, that I wanted to speak about with you was what's happening in agri commodities, and in particular sugar, and just an extension of moving away from fossil fuels. The Indian Prime Minister Narendra Modi, for instance, is now pushing forward for sugar-fueled cars, or ethanol blending is what he's pushing forward. He's also, pushed ahead the timeline by 2025 when he wants 80% of all, constituents to be blended 80% with ethanol, that is. Just wanted to understand what is it that you're foreseeing now on sugar? Because going by the stock prices here back in India, it seems that this is a super cycle that we're at the cusp of.
Well, as you know, cars can be fueled with sugar fuel, but the Brazilians are already working on it. The Americans are working on it, well, from maize, but we can have fuel that is based on agriculture, and that's going to happen. I would just go back to, if I could, we're going to have electric cars, but it's good for some commodities. Remember, an electric car uses several times as much copper and lead and nickel as does a regular car. Likewise, if we have fuel based on sugar or maize or whatever, you're going to see a lot more demand in several commodities, even though we may see oil eventually being used less and less and less. There are many ways to play commodities, and commodities are certainly the cheapest asset class that I know in 2021.
Sure. So in the entire agri-commodity basket, where is it that you're placing your bets? What are you bullish on?
Well, I have been buying the ETF. There's an ETF on the New York Stock Exchange, a commodity and an agricultural ETF, RJA. I continue to buy it. It's been down recently, and it is, as I look at the world, agricultural commodities are among the cheapest asset in the world. So I've been buying more of the Rogers Agricultural ETF. I don't know of any other asset class that is as cheap as commodities, especially agricultural commodities, anywhere in the world. And that includes silver, which is not agricultural.
Okay. Well, Jim, I know that it's not just silver, but also gold that you have really been a long time bull on. Let's just recap what's happened in this last 1-2 odd weeks. We had real yields in the US fall to, new lows. The dollar index as well had been a little on the down low, very, very subdued. This creates the perfect storm for gold to rally, but we haven't really seen that happen. And plus, mind you, the scare around the Delta variant as well emerging in several pockets of the world. Still, we've seen gold very, very muted, very, very subdued. And you know what they say, if it doesn't rally on good news, it probably won't rally at all. What's your take there? Or is it that, within the precious metals basket, you are more towards favoring silver than gold?
Well, I'm not buying either at the moment, but again, I'm not a good trader, but I am waiting for silver and gold to correct even more. If I were buying today, I would buy more silver than gold. Silver is down 50% from its all-time high. Gold is down 10% from its all-time high. I'm not buying either at the moment, but when I buy again, I will probably buy a lot more silver than gold. And I will watch ET to figure out when to buy.
Well, thanks a lot once again, Jim, for an endorsement for you and from you. And let's talk now about the dollar index. Again, you've time and again reiterated that the dollar is an extremely weak currency simply because of the enormous amount of debt that the Americas have taken on board. Do you continue to see the US dollar as a safe haven index, as a play in that direction, or do you think that there have been other asset classes which have come in as a store of value which better play the role of safe haven?
Well, I still own the U.S. dollar. It is rallying now. It was down for a while. When things go wrong, people look for a safe haven, and I suspect that they will look for the U.S. dollar at least one more time. But no reserve currency has lasted more than 100 years, 150 years throughout history. The U.S. dollar has been around for a long time. So we're coming to the end, not this year, maybe not even in the next 2 or 3 years. But the U.S. dollar is extremely vulnerable because it's got such staggering debt. I do not know yet what will replace the dollar. Yes, many people will go to silver, including me. But I do not know what currency, if any, will replace the dollar. I am looking, many people, India, China, Russia, you're all looking for something to compete with the U.S. dollar. Again, maybe you can tell me, you're there in India, and India is one of the countries which is looking for something to compete with the dollar. And it should. The U.S. is the largest debtor nation in the history of the world.
Well, I'm not sure about the dollar, but we're definitely creating our own digital currency to compete with the most popular one out there. Jim, in one of your earlier answers, you mentioned that there are several ways to play commodities. Even though you have your ICEs, which will perhaps reduce over time in production, you'll have EVs taking their place, and EVs will use a lot more copper, a lot more nickel, a lot more of some of these base metals. How would you play that space then, or would you want to participate in that at all right now, given the fact that you mentioned EVs are still a while away?
Well, I own the commodity, as I said before. Commodities are the cheapest asset class that I can see anywhere in the world in 2021. So I continue to buy indexes, commodity indexes. They're listed. They're easy to do now. You can buy them on the New York Stock Exchange and other stock exchanges. And many studies have showed that index investing is the best way for most investors most of the time. And I know, and I'm lazy. I know that index investing works. I'm bullish on nearly all commodities, so I have been investing in commodity indexes on the New York Stock Exchange. I mentioned one symbol, RJA, RJI.
Okay, there seems to be a bit of an audio issue. We'll just get back and repatch that line with Jim in just a second from now. But a couple of interesting anecdotes coming in, saying that he continues to believe that commodities is the cheapest asset class out there right now, more bullish in silver as opposed to gold, not buying anything as of now though. He's saying that the US dollar is extremely vulnerable because of the staggering debt. This is a view that Jim has maintained for some time to come now. He's also saying that he's buying agri-commodity and he's invested in the largest agri ETF in the US markets right now, saying that EVs are also going to use several other metals, that's copper, lead, nickel, that are going to be, more of use, and EVs and more EVs. He's saying you cannot shrug away from the fact that EVs are going to come, but it's going to take some time to come, according to him, in a large commercial way. But that said, just his views on crude as well is what I'd like to highlight here. While he continues to say that, crude continues to be, or rather commodities continue to be the cheapest asset class, he's saying that, when it comes to crude, while the near-term aberrations are something that you can't shrug away from. And in the longer term, you are going to see more and more countries move away from fossil fuels, thereby the demand is bound to come down. Quick check then on where the markets are. Status quo really absolutely flat right now. The breadth of the market just marginally better. Then, Jim, the other thing I wanted to talk to you about is how is it that you foresee interest rates are going to pan out? While right now they are at an all-time low, the Fed has made very clear that they are not going to move on interest rates anytime soon. So in that sense, sort of, taking away from the threat or fear of taper tantrum. But what is your own sense and how long central banks across the world, given the high inflationary scenario that we are in currently, the fact that growth has come back much faster than anticipated, how long will they be able to hold interest rates low?
Well, Mubina, interest rate bonds are in a bubble. Bonds are clearly in a bubble. They've never been this expensive in the history of the world, in the known history of the world. And we're going to see higher interest rates. The central banks will do their best to hold them down, but there comes a time, including already starting, when the market says, no, we don't care. We're not going to play this game anymore. Central banks are going to try to hold the line, but come on, I mean, the debt is skyrocketing everywhere. The supply of debt is gigantic and inflation is coming. All the fundamentals are going against interest rates. I'm not buying, I'm not shorting interest bonds today, but there's no question that interest rates will be going higher, maybe not this quarter, but certainly over the next 2 or 3 years and more. Interest rates have to go much higher worldwide. There's nothing that can stop it, including central banks.
Yeah, because the ECB has mandated saying that negative rates are going to stay here for longer. The Bank of England has said that the Delta outbreak concerns overpower any hawkish stance, and the Fed also has said that rate increases are still far away. But Jim, in that sense then, would you say that if the markets have already begun to sense it, are we looking anywhere at a peak for equity markets?
Well, there's going to come a time when the market is going to say to the central banks, we don't care. And when the market takes control, which it will again someday, that's when it's going to be a very, very serious problem for all of us, equities, property, bonds, everything, because when the market's in control, then they will drive interest rates very high. As I said, there's a huge supply of bonds out there and many, many more coming. There is inflation. All of these things are basic fundamentals that drive interest rates higher. And the central banks in the past have lost control at times, and they will lose control again. And when that happens, we're going to have the worst bear market in equities in my lifetime. In 2008, we had a problem in the equity markets because of too much debt. Mubina, the debt is skyrocketed everywhere since 2008. Everywhere. You see gigantic debt now. So the next time we have a bear market, it's going to be terrible.
All right. Okay. Jim, how do you see, the prospects of higher interest rates play out for EMs like India? So far, in fact, in this year, perhaps, further edged on because of what China is doing in terms of its regulations, we have seen EMs underperform the developed markets so far this year. Firstly, what according to you is the trigger? And secondly, how could the higher interest rate scenario play out for EMs and DMs?
You watch ET to get the trigger. These things always start, in the marginal markets where people aren't looking. You're starting to see the Chinese stocks go down. You're starting to see problems in some banks in some small countries. You're starting to see problems. That's the way it usually works. Eventually, everybody knows. And in 2008, Lehman Lehman Brothers went bankrupt finally, and then everybody knew there was a problem. But that had been building for several months with many markets around the world. We're starting to see problems. I mentioned China. We're starting to see problems in some markets. I'm not selling out yet of equities, not by any stretch of the imagination, because there's still many stocks around the world that haven't gone into a bubble yet. I expect everything to go into a bubble eventually. But when that happens, probably later this year or 2022, that will be the end. And then we're going to have a horrible bear market. Because for the reasons I said, I mean, I'm not some doom and gloomer. I'm just telling you that the debt is much, much higher now than it was in 2008. And the next bear market has to be very, very bad.
Well, that's a bit of a frightening prophecy, really, there, Jim.
No.
Do you think that FIIs are already sensing this, Jim?
It does not have to be bad for you. It's good for you. You have job security. Somebody has to report the bear market. Somebody has to tell us what's going on. It may be bad for me and many other people, but it's not bad for journalists.
I guess all of us, including our production team, now can heave a sigh of relief. Jim, thank you so much. It's always such a pleasure interacting with you and getting in your insights. Thank you so much, as always, for being so frank and candid with us.
My pleasure. I suggest you get Henry Ford's wife to talk about electric vehicles. Bye-bye. Bye-bye.
Well, we definitely do that. Thank you so much, Jim.